Good morning, good afternoon, good evening, guys, and welcome to another video of the Diving Trader. My name is Daniel, and today, guys, it's the 9th of April. 9th of April, and people are wondering what the hell's going on. We're going into April, and we're still in a red market. So yeah, there's probably a lot of people out there that are a little bit desperate at the moment, thinking, right, come on, we need a green market. And a lot of this is about patience, guys. It could come around the corner, could start to have green days next week. We just don't know. We could be in for more red days. So you guys are used to hearing a lot of YouTubers out there giving advice and listening to them, and all of us all have our own journey. A lot of us are still learning. I don't think we ever stop learning. No one ever stops learning, regardless of how experienced you are. But I think it's sometimes good to sort of sit back and actually keep learning. Okay, so not being persuaded about how the market's working or who tells you what to do, but you need to take your own decisions based on people that have experience. So there are three people that I really look up to. There are many actually investors I look up to, but three of them, my top three, are Peter Lynch, which is the guy you see on the screen. I love this guy. He's one of my favorite investors. Of course, you can't go without saying Warren Buffett. And third, the most modern investor of today, which is Cathie Woods. So those are the three people that I really look up to. And I think I'm going to do the first video today just on Peter Lynch, and then I'll do further. I'm going to sort of get advice from all these investors and put it all together in one video. So the first one here we have is Peter Lynch. What he says back then, so this is quite an old video, what he says back then is still valid today. Okay, so this is not like something that sort of is old news. No, what he says, really, we can take on board, learn what he's saying, and apply it for today. So let's go in and let's listen to what he has to say.
Financial markets today, do you think something needs to be done to reduce it?
I love volatility. I think I remember when in 1972 the market went from down dramatically, and Taco Bell went from 14 to 1. They had no debt. They never had a restaurant close, and I started buying at 7, but I kept on to it, and it went to 1. And it was the largest position in Magellan in 1978 when it was bought out by $42 by Pepsi-Cola. And I think it would have gone to 400 if they didn't buy it out. I think volatility is terrific. I think it is I think these callers are very important. I don't think the market going up 80 points one day and down 80 the next is a good thing for the public. I think that's not a very good thing. But I think all these callers and all these other things, to keep the volatility down each day is important. But the market's going to go up and down. Human nature hasn't changed a lot in 25,000 years. And some event will come out of left field, and the market will go down or the market will go up. So volatility will occur, and markets will continue to have these ups and downs. I think that's a great opportunity if people can understand what they own. If they don't understand what they own, they can own mutual funds, try and figure out what mutual funds they own, and keep adding to it. Basically, corporate profits have grown about 8% a year historically. So corporate profits double about every 9 years. The stock market ought to double about every 9 years. So I think the next market's about 3,800 today, 3,700. I'm pretty convinced the next 3,800 points will be up. It won't be down. The next 500 points, the next 600 points, I don't know which way they're going. So the market ought to double in the next 8 or 9 years. It ought to double again in the 8 or 9 years after that. Because profits will go up 8% a year, and stocks will follow. That's all there is to it. But you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot.
Okay, so this is key, guys. This is key. We hear a lot of us YouTubers talking about it, but this is really key. So listen to what he has to say here, because this part's really important.
The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means, that's a euphemism for losing a lot of money rapidly, but we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet and they're doing fine, and you're hoping to get to 22 with it. 14 to 22 is terrific. 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own. Because a lot of times people buy on the basis the stock has gone down this much. How much further can it go down? I remember when Polaroid went from 130 to 100. People said, "Here's this great company, great record. If it ever gets below 100, just buy every share." And it did get below 100. A lot of people bought on that basis, saying, "Look, it's gone from 135 to 100. It's now 95. What a buy!" Within a year, it was 18. And this is a company with no debt. I mean, this is a company. It was just so overpriced, it went down. I did the same thing in my, I think my first or second year at Fidelity. Kaiser Industries had gone from $26 a share to 16. I said, "How much lower can it go?" It's 16. So I think we bought one of the biggest blocks ever on the American Stock Exchange of Kaiser Industries at 14. I said, "It's gone from 26 to 16. How much lower can it go?" Well, at 10, I called my mother and said, "Mom, you got to look at this Kaiser Industries. I mean, how much lower can it go? It's gone from 26 to 10. Well, it went to 6, it went to 5, it went to 4, it went to 3. And now I am fortunate this happened rapidly, or I would probably be still caddying or working at the Stop and Shop, but it happened fast. So I was able to, it was compressed. And at 3, I figured out, there's something very wrong here because Kaiser Industries owns 40% of Kaiser Steel, they own 40% of Kaiser Aluminum, they own 32% of Kaiser Cement, they own Kaiser Broadcasting, they own Kaiser Sand and Gravel, Kaiser Engineers, they own Jeep, they own business after business, and they had no debt. Now, I learned this very early. This might be a breakthrough for some people. It's very hard to go bankrupt if you don't have any debt. It's tricky. Some people can approach that. It's a real achievement. But they had no debt, and the whole company at 3 was selling at about $75 million. At that point, it was equal to buying one Boeing 747. I said, "There's something wrong with this company selling for $75 million. I was a little premature at 16, but I said, "Everything's fine, and eventually this will work out." And what they did is they gave away all their shares to their shareholders. They passed out shares in Kaiser Cement, they passed out shares in Kaiser Aluminum, they passed out their public shares in Kaiser Steel, they sold all the other businesses, and you get about $50 a share. But if you didn't understand the company, if you're just buying on the fact the stock had gone from 26 to 16, and then it went to 10, what would you do when it went to 9? What would you do when it went to 8? What would you do when it went to 7? This is the problem that people have, is they sell stocks because they didn't know why they bought it, then it went down, and they don't know what to do now. Do you flip a coin? Do you walk around the block? What do you do? It's psychiatry.
So this is key, guys. This is key. You've been hearing it all the time, and I say it again. You need to know what you're buying. This is absolute key. We've seen a lot of people in the market that have come in recently, and they're listening just based on what someone's told them to buy. So it's really important that whoever says, whether it's me as a YouTuber or it's any other YouTuber, even if it's an expert, really telling you to what's good or recommending a stock to buy, you still need to go in and do your own research. So this is absolute key, and this has been said time and time again. And okay, guys, we're going to have another clip here. So that's a little bit on volatility in the market, and now we're going to listen a little bit on Peter Lynch on how to pick stocks. Again, this is great advice. Let's listen to this great advice.
You shouldn't be intimidated. Everyone can do well in the stock market. You have the skills, you have the intelligence. It doesn't require any education. All you have to have is patience, do a little research. You've got it. Don't worry about it. Don't panic.
In 1990, Peter Lynch retired as manager of Fidelity Magellan, the nation's largest stock mutual fund, and one of the most successful. In 13 years, he drove Magellan to a 2,800% gain. Quite simply, Lynch has been recognized as one of the greatest money managers ever. He beat the stock market for so long not by timing the market, but by picking the right stocks. Of course, no one can promise you Peter's record, but you can learn a lot from him. And you don't need a billion-dollar portfolio to follow his rules.
Hi, my name is Peter Lynch. For 13 years, I managed Fidelity Magellan Fund. Those were 13 amazing years. 9 times the market declined by 10% or more, and I was very consistent. All 9 times Magellan Fund fell 10% or more.
I'm sorry about the quality, guys. The quality of the video is not that good.
I learned a lot of lessons. I think they're true now. I think they were true 20 years ago. I think they'll be true 20 years from now. I think I can help you do a better job of investing.
You can't learn years of stock picking experience in one night, but you have better stock picking skills than you realize, and you have advantages that no one on Wall Street has. In Stock Shop, I'm here to help you find them and use them. You may be wondering why stocks are so important for a long-term investment program. The short answer, over time, stocks produce better returns than other investments. The past 60 years, stocks have returned about 10% a year. Bonds have averaged 6% a year. Treasury bills or bank CDs around 3%. That doesn't seem like a big difference, does it? But the power of compounding makes an enormous difference over time. Suppose you invest $50 a month and earn 6%. After 30 years, you have over $50,000. Go ahead and play with the numbers yourself.
Because you don't pay taxes on the money until it is withdrawn from the accounts, the power of compounding achieves the maximum effect, providing you the best return possible.
The more time you have to let your earnings compound, the better results you'll get. A 20-year-old who invests $200 a month and earns 10% on his money all along will have $1.1 million by the time he was 60. A 35-year-old would have to invest $800 a month to have the same $1.1 million at age 60. You're going to have a tough time getting that 10% return without at least some stocks in your portfolio. Before you start to invest, ask yourself one question. When will I need to use this money? The stock market is a long-term investment. If you need to use the money anytime soon, you should not invest in stocks.
This is money you're willing to put in the market and leave it there for 5, 10, 20, 30 years. That's the kind of money you can do well with. If you're worried about it, don't invest it. The stock market is volatile. Individual stocks are volatile. The average range for a stock in a year is 50% between its high and its low. Stocks go up and down. The market goes up and down. If you're investing with a 1 or 2 year time horizon, you shouldn't be in individual stocks. You shouldn't be in equity mutual funds. If you've been lucky enough to save up lots of money to send your children to college and they're starting school in 2 years, what are you going to do if the market goes down?
In the long term, 10, 15, 20 years or more, stocks have beaten bonds and banks' certificates of deposits. But in the short term, there's no telling what will happen. In 1987, the S&P 500 fell 33% from its August top to its October bottom. If you had the stomach to ride through that drop, you would have found that the S&P performance from 1987 through 1992 still outperformed Treasury bills and long-term government bonds, despite that decline. If you want to double your money quickly and safely, fold it in half and put it in your wallet. Any other way, you're simply gambling. A good stock can take 2, 3, even 5 years before it really pays off. It's not 2 or 3 weeks. It's not 2 or 3 months. My best stocks have been in my 5th, 6th, 7th year. Give your investments time to grow.
Okay, so that's a key point, guys. Here, we're looking at the market today, and we've seen we're buying stocks, recent stocks. Let's say we bought them back in January. They've gone sky high. They've gone up 40, 50, 60, 70%, and now we're seeing them down minus 20%. People are expecting it to go back up the next day, and we can't expect this. If you're in the stock market and you're looking for these short returns, I'm talking about stock, by the way, so I'm not talking about options. I'm not talking about leveraging or using margins. I'm talking about pure stocks, or if you're day trading, again, that's another story. So we're talking about stocks here. So if you're looking for stocks for the long term, you need to be taking the money that you have and not needing that money. That's really important as well. Okay, so it's just reiterating what Peter Lynch is saying. So, yeah.
People ask me, when is the right time to sell a stock? Selling stocks is a matter of comparing stories. If story A is better than story B, then sell B and buy more A. If you own 8 companies, you're playing 8 simultaneous games of poker. So only stay in the games that you have the best chance of success. But remember that stories rarely change overnight. It may take years for a good one to be recognized by the market. Give your good stories the time to grow.
Your advantage in picking stocks is your direct experience with companies as a consumer, on your job as a professional, or as a neighbor. Use those advantages as a place to start looking for good stocks.
You have several things that you possess that will make you a good investor. They're inherent to your life. It's the field you work in. It's the area where you live. There may be some local company that's terrific. You're a consumer. You see some products. You see some services that are terrific.
You can't just go out and buy a stock and hope it goes up. You have to have a reason why you think a stock will go up. You should be able to tell those reasons to someone else in just a few minutes. People who love stocks don't talk about sports. They don't.
No, this is key, guys. If you can tell someone in less than a minute why it's good to buy this stock, what the reason why you're buying this stock, and you can explain that in less than 1 minute, give all boom, 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 loads of catalysts or their financials or whatever, that's good. That's a good sign. If someone asks you why you invest that stock and you don't know how to answer that, that you sort of have to be thinking why you invest in that company. So, guys, that's just a little bit of a little bit of tips and tricks that Peter Lynch can give us. There's lots more content out there. If I put the content really out there, it'd be hours worth of work from Peter Lynch. If you want to know more, you can obviously have a look on YouTube for Peter Lynch. You can find a lot more content on there, old videos. And also, I recommend this book. Really, this is called One Up on Wall Street with Peter Lynch. And yeah, you can buy this on Amazon on paperback, soft version, or Kindle, or you can even buy the audiobook. So that's my recommendation. Guys, I hope you've enjoyed this video. I hope you learned something from it. Please make sure you hit that like button. That really helps my channel grow. And if you're new to this channel, just hit that subscribe button. That really helps my the YouTube algorithm. Guys, thank you very much for watching. Take care and speak to you soon. Bye bye now.